In the realm of financial wisdom, the adage, "a penny saved is a penny earned," has stood the test of time, echoing through the ages as a beacon of prudence. It's a simple yet profound reminder that every coin not spent is one that stays in our pocket, contributing to our wealth. This maxim is often linked to Benjamin Franklin, symbolizing the virtue of frugality. It suggests that being economical and saving money are just as valuable as earning it. Saving money is vital, but it is only the beginning of a journey towards true wealth. Can saving every penny lead to financial independence? There's more to the story. Let's unpack why saving alone won't make you wealthy. Number 1. Inflation. It's basically how rate prices for things are going up, making money worth less over time. To quantify this effect, economists use various indices, with the Consumer Price Index, CPI, being the most prevalent. The CPI keeps track of how prices for a set of common items that people buy change over time, providing a concrete gauge of inflation's impact on the economy and individual purchasing power. The CPI looks at the cost of all sorts of things people buy regularly to see how much more expensive they become. This helps us understand how inflation is changing the value of our money. If you're only saving without investing, inflation can erode the value of your hard-earned pennies. For example, imagine you have a $100 bill that you decide to keep in a drawer for a year. During that year, the inflation rate was 2%. This means the prices for things generally increase by 2%. So, a basket of groceries that cost $100 last year now costs $102. Your $100 bill can no longer buy the same number of groceries because its purchasing power has decreased due to inflation. Now, if you had put that $100 into an investment account with a 4% return, at the end of the year, you would have $104. Even though the price of groceries went up, you can still buy the same basket and have $2 left over. This simple example shows how investing can help you keep up with or even outpace inflation, preserving or increasing the value of your money over time. To protect your finances from inflation, consider investing in assets like stocks or real estate. Investing in stocks or real estate can be a wise strategy to safeguard your finances from inflation. Stocks can offer returns that often beat inflation because companies may raise prices, leading to increased profits and stock values. Real estate also tends to keep pace with or exceed inflation, as property values and rents rise with the cost of living. Another smart move is to buy Treasury inflation-protected securities, TIPS, which are U.S. government bonds tailored to safeguard against inflation. The principle of TIPS adjusts with inflation. It rises with inflation and falls with deflation, but you will always get back at least what you initially invested when they mature. Interest is paid semi-annually on the adjusted principal, so payments vary with inflation. At maturity, you're guaranteed the greater of the adjusted or original principal, ensuring your investment doesn't lose value over time. While interest and principal increases are federally taxable, they're exempt from state and local taxes. TIPS, available in 5, 10, or 30-year terms, can be a prudent addition to a diversified portfolio for those seeking a low-risk inflation hedge, purchasable via the U.S. Treasury or investment funds. Also, spread your investments across different types. This strategy is key to managing the risk of inflation because not all investments react to it in the same way. By having a mix of investments, you can balance out the risks. Number 2. Opportunity cost. It is about understanding the value of what you're giving up when you choose one option over another. It's the benefits you miss from not picking the next best choice. For instance, if you watch a movie instead of studying, the opportunity cost is the study time you've lost. This concept isn't limited to money. It applies to all life decisions, where every choice means you're not choosing something else, be it time, happiness, or potential earnings. Recognizing opportunity costs helps in making informed decisions, like considering whether to spend on a holiday or save and invest that money for future gains. It's about finding the balance that maximizes your overall benefits. Investing in a variety of assets like stocks, bonds, or mutual funds can lead to higher returns compared to a low-interest savings account, though they come with different risk levels. Stocks offer a piece of a company's ownership and the chance for substantial gains if the company thrives, but they can also decline in value. Bonds, considered safer, are essentially loans to entities that pay back with interest, typically yielding lower returns than stocks. Mutual funds, managed by financial professionals, pool various investments together, offering diversification and the potential for better returns with moderate risk compared to investing in individual stocks. For example, saving $10,000 in a bank account with a 1% interest rate yields a modest $100 after a year, bringing the balance to $10,100. In contrast, investing that amount in the stock market with an average 7% return could net $700, increasing the balance to $10,700. This big difference shows the choice between the safety and guaranteed return of a bank account and the chance to make more, but with more risk in the stock market. Stocks might go up in value and give you extra money, but they can also drop in value, which makes them uncertain. Balancing your financial goals and risk tolerance is crucial, and diversifying across various assets can help mitigate risks while striving for greater returns. It's a decision that should align with your long-term financial planning and comfort with market volatility. Number 3, risk aversion. In finance, being risk-averse means you would rather be safe and avoid risks, even if it means you might not make as much money. People who don't like taking risks prefer sure things, choosing smaller but guaranteed profits instead of bigger but unsure ones. They tend to have a low tolerance for risk, favoring investments like savings accounts, certificates of deposit, and government bonds, which offer stability and predictability. This cautious approach influences their investment decisions, leading to conservative portfolios focused on capital preservation. In fluctuating markets, they may forego possible profits to avoid losses, emphasizing the need for financial strategies that provide easy access to funds. Understanding one's risk aversion is essential for financial planning, as it guides the selection of investments that align with personal goals and risk comfort levels. Being risk-averse can lead to overly conservative financial decisions that hinder wealth growth. If you are worried about taking financial risks, here's a simple guide. Educate yourself about investments to make smarter choices. Look at the big picture and aim for long-term financial goals. Diversify your investments to minimize losses. Understand your risk tolerance and invest accordingly. Consult with financial experts for advice that suits your goals. Be mindful of emotional biases in decision-making. Start with small investments in riskier assets and increase them gradually. Use financial tools for protection against losses. These guides can help you become more confident in taking calculated risks, which may increase your chances of earning more in the future. In conclusion, while the adage, "a penny saved is a penny earned," underscores the importance of saving, but it's not enough to get rich. You need to think about how inflation can make your savings worth less over time, and how choosing one thing to do with your money means you can't do something else. To keep up with inflation and make smart choices, you can invest in things like stocks, houses, or special government bonds that keep up with inflation. It's also smart to spread your investments around so you don't lose everything if one goes bad. And if you're not sure about taking risks, learning more about investing, getting advice from experts, and starting small can help you make better decisions. In the end, growing your money is about making smart choices, not just saving it. Thank you for watching. I hope you found this video helpful and informative. If you found this video helpful in any way, please leave a comment below. I'll see you in the next video.